Welcome to our deep dive on handling unexpected state or federal tax refunds when closing an estate or trust. In this video, we will clearly explain when the estate or trust needs to file again, how the tax benefit rule affects beneficiaries, and what trustees should do before distributing funds. We will move step by step so you can follow along and avoid common pitfalls. Here is our agenda. First, we will cover why refunds show up after closing. Next, we will address whether a new return is needed. Then, we will break down the tax benefit rule in practical terms. After that, we will decide who reports the income. Next, we will work through a trustee checklist. Then, we will use examples and visual diagrams. Finally, we will test your knowledge with quick quizzes. Refunds can arrive after final returns have already been filed for an estate or trust. This is a normal occurrence due to processing times or adjustments by tax authorities. The key is to understand how to handle the refund without reopening the entire administration unnecessarily. Before we continue, please note this is educational content only, and not tax, legal, or accounting advice. Because facts vary widely across estates and trusts, consult with a qualified professional for your situation. Here is the practical rule of thumb. If the estate or trust has already filed its final return, and there are no remaining assets and no new income, then typically a new return is not required solely because a refund arrived later. However, if there are still assets or the entity earned new income, a return may be required. Assuming no new return is needed, the focus shifts to beneficiaries and whether they must report their shares of the refund as income under the tax benefit rule. The tax benefit rule determines whether the refund is taxable to the recipient. If the original tax payment was deducted on a prior return, either by the decedent on Form 1040 or by the trust or estate, then the refund provides a prior tax benefit and is taxable to the recipient when received. By contrast, if the standard deduction was used, or the tax payment did not generate a deduction, then the refund is usually not taxable. Importantly, the reporting year is the year the refund is actually received. On the left side, when a prior return itemized state and local taxes, or otherwise deducted the tax that led to the refund restores a prior benefit and becomes taxable to the recipient in the year received. On the right side, when the standard deduction was used, or there was no deduction for that tax, the refund does not restore any benefit and is generally not taxable. As a result, there is no income to report. Usually, the state, or IRS, issues the refund to the estate or trust. The fiduciary then distributes the funds to beneficiaries according to their shares. Whether the beneficiary must report the amount as income depends on whether the original tax payment generated a tax benefit. Trustees should clearly inform each beneficiary whether their distribution is taxable based on the deduction history. Here are the practical steps for trustees. First, confirm that final fiduciary returns were filed. Next, verify how state and local taxes were treated. Were they itemized, or did the return use the standard deduction? Ask the tax preparer for supporting documents or work papers that show whether a deduction was claimed. Then, tie the refund to the specific year and return that generated it. Based on that, determine taxability under the tax benefit rule. Document your conclusion and communicate it in writing to each beneficiary. Finally, distribute funds and indicate the correct year for beneficiary reporting. This table summarizes common scenarios. When the estate used the standard deduction with no state and local tax deduction, the refund is generally not taxable to the beneficiary. When the decedent itemized SALT on a prior Form 1040, or the trust deducted the state tax on Form 1041, the resulting refund is taxable to the beneficiary in the year it is received. If the refund relates to an amount that was not deducted, such as a non-deducted penalty, it is generally not taxable. This pie chart is for illustration. It highlights that in many practical cases, refunds may be taxable when there was a prior deduction, while a meaningful portion are not taxable when the standard deduction or no benefit applied. Your actual outcome depends on the prior deduction history. Here is a quick reference in Markdown form. The decision rule is that if the prior return took a deduction for the tax that was later refunded, the refund is taxable in the year it is received. If the prior return used the standard deduction, or took no deduction for that tax, the refund is not taxable. As a tip, Request the preparer's work papers to see exactly how state and local taxes were treated. A simplified formula is that the taxable refund is limited to the prior year tax benefit created by the deduction, not exceeding the refund amount. Quiz time. A beneficiary receives a refund distribution from a trust, and in the prior year, the decedent itemized state taxes on Schedule A. Is the refund taxable to the beneficiary? Option A, yes, taxable in the year received. Option B, no, because refunds are always tax-free. Option C, taxable only if the trustee files a new return next year. Option D, never taxable if the trust is closed. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is yes, taxable in the year received. Since the prior year itemized state taxes, the refund restores a prior tax benefit and is therefore taxable to the beneficiary under the tax benefit rule in the year the refund is received. Second quiz question. If a refund arrives after final estate or trust returns are filed, and there is no new income or remaining assets, must the estate or trust file again solely because of the refund? Option A, yes, a new return is required next year. Option B, no, generally no new return is needed if everything was disbursed and there is no new income. Option C, only if the refund is over $5,000. Option D, only if there are multiple beneficiaries. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is no. If the final returns are filed and the estate or trust has no remaining assets and no new income, a new return is generally not required solely due to the refund. Instead, the focus shifts to the beneficiary's tax reporting under the tax benefit rule. This timeline shows the chronological flow. First, the fiduciary files the final returns. Next, assets are disbursed. Afterward, a refund may arrive. Then, the trustee verifies how taxes were treated on the prior return with the preparer and determines taxability under the tax benefit rule. Next, beneficiaries are notified of the tax status. Finally, beneficiaries report any taxable amount in the year the refund is received. These are the essential points. A new entity return is generally unnecessary if the final returns were filed and there are no remaining assets or new income. Beneficiary taxation hinges on the tax benefit rule. If a prior return itemized state and local taxes or otherwise deducted the tax, the refund is taxable to the recipient. If the standard deduction was used, it is typically not taxable. Trustees should verify the deduction method with the preparer before distributing funds. To conclude, confirm that final returns were filed and there are no remaining assets. Trace the refund to the originating tax year. Apply the tax benefit rule to determine taxability. Document your findings and communicate clearly to beneficiaries so they know whether to report the amount in the year received. Thank you for watching. If this video helped you, please like it, share it with your fiduciary team, and subscribe for more estate and trust guidance. Leave your questions or scenarios in the comments so we can address them in future content.